Thank you very much, Ryan. And let me just share my screen here. Give me just one moment. Want to get the right screen. Okay, great. All right, everyone should be able to see my presentation here in the full screen mode. Thank you very much, and I appreciate the opportunity. Um, and let's dive in. We're going to be talking about risk rating 2.0 today, which I know a lot of you have heard about. This is the change in rating that the NFIP is implementing October 1st, but because of the 30-day wait for new policies without a close, a loan closing, technically risk rating 2.0 has already started. So we're going to look at, we actually have some rating examples to show you, and we're really going to be diving in here. There may be some complicated topics that I've tried to streamline, but please, I apologize if some of them are a little complicated, but we'll get started here. So from my perspective, this is a little bit about me. Most of you have either heard or heard me speak or know about me. I'm Joe Rossi, known as Joe Flood, for the exact reason that I'll be speaking today, because of flood insurance and flood related issues. Formerly at Rogers Gray Insurance, earlier this year in June, I moved on from Rogers Gray and I'm now an independent consultant and broker. So still a great resource for associations like this. So I appreciate you guys having me here today. And again, here's a list of some of the different boards and committees that I'm on. Really, I show this slide mostly to give you a perspective of where I'm coming from, understanding the changes in insurance rating here coming up October 1st and currently. So let's dive right in. What is risk rating 2.0? Many of you have either heard of this or heard that there was a change coming with the NFIP, National Flood Insurance Program, and that is exactly what's happening. It will make flood easier. So yes, technically it does make things easier to understand. There's not as many questions when we're putting it into the programs that generate our rates. There'll be less complication when it comes to rating tables and all the different things that the NFIP had before. But what we're finding in the real world, which just started at the end of August when we were able to get our hands on the insurance rates themselves for the first time, things are not exactly as they seem. And we'll talk about that a little later. But basically, it's what risk rating 2.0 is it's a total redesign of the rating structure. So in FEMA's words, it's delivering rates that are fair, clear, and meet current industry standards. Those are what FEMA says that the rates should be doing. But the most important and easiest way to explain this is that it's no longer binary. So in the risk rating, we'll call it 1.0 world, and I reference it as the 1.0. So we're going into 2.0, and today we're in 1.0. What happens is you're in a V, an A, or an X zone. And each one of those zones has some impact or implications on the rates, right? If you're in a V zone, that usually means you're closer to the water. The rates are typically higher there. If you're in an A zone, you're a little bit further from the water or in a river type of situation, and the rates are even less there. And then in the X zone, that's in the areas considered not in the high risk flood zone, and the rates are even cheaper there, and flood insurance isn't required. So imagine now going from a stair step, much like that, to a ramp. So X zones, A zones, and V zones now no longer mean anything. And we're going into a world where if you're closer to the water, it may be more expensive than if you're further away from the water. But then in certain instances, it actually may not be less expensive depending on distance to the water and the height of the building and all the other factors that risk rating 2.0 takes into consideration. And the example on the screen, which I apologize is a little bit small, but it basically highlights this. And so the example is you see a little green dot. On the left side of the left example, that is an AE zone, and on the right side, that is an AE zone. So same zone, and in today's world, the premium for all intents and purposes would be the same. But in the example on the left under 2.0, because that building is so much further away from the water source, among other rating factors, which we'll talk about in a moment, the premium is $500 versus the one on the right, which is very close to a couple water sources. And we'll actually see the premium go up to $2,500. So what you're seeing there is just one example of how 2.0 is moving from kind of an in or out or high risk versus low risk, and really going to take a lot more rating factors into consideration. So what are those rating factors? Well, today there's several that we use, and going under 2.0, there's going to be a lot more that the program considers, that the rating engine considers. So currently, risk rating 1.0 basically takes your FEMA source data. So that's going to be your flood insurance map, right? And that's going to be your BFE, so your flood elevation, your flood map, so where you are on that map in the zone, the foundation type, so whether you have a basement, crawl space, enclosure, that type of thing, and your elevation, so how high are you in comparison to that base flood elevation, or that is shown on the map. And then it takes the 1% chance of flooding, which is those shaded zones, and adds fees and surcharges, and you come up with risk rating 1.0's rate. Well, under 2.0, you can see that there are several other considerations made in determining premiums. It takes additional government source data, so that would be the FEMA flood map, in addition to flood modeling, so the catastrophe models that computers are using to generate your risk. It takes other third-party data such as replacement cost and other things, and puts it into the rating factors. And then it adds a bunch of other rating variables: your distance to water, your stream order. So basically that means how big or small are the rivers that you're near. Now on Cape Cod, we don't have any regulated floodways, so that would not be a consideration. So again, not all of these are considered, but these are all the things that could be considered. The flood type. So FEMA has built 5 different flood types in, and I'm getting better at remembering all of them, but I don't have them all down. I'm pretty sure it's coastal erosion, storm surge, riverine, tsunami, and Great Lakes. I got them all that time. So we certainly wouldn't be considered for Great Lakes flooding here, but you could be considered for coastal erosion. And because they will consider multiple types of flooding, you could also be considered as storm surge at the same time. I would imagine those are probably the 2 most common rating factors that will be thrown into rates around here anyways. The ground elevation still matters, but not the base flood elevation. In fact, imagine a world where the elevation of the water on the flood map no longer matters. That's the world we're in now, because we're comparing everything to ground elevation. And I'll show you an example of that a little later. First floor height, construction type, and foundation type. So now the type of construction that the building is, frame, masonry, these matter now. The cost to rebuild. So it takes that replacement cost data that FEMA is generating, and that is part of the rating considerations. So the more expensive your building is, the higher the rate will be. The less expensive, the lower the rate. And there's a whole methodology on why that's the case that I won't dive into, but that is one of the rating factors. And then a broader range of flood frequencies. So they're measuring the rate based on the 1% all the way to the 100% flood. So there's a lot of other rating factors or frequencies that are considered, and then fees and surcharges are thrown in. So I started off by saying that it's going to make things easier, but it certainly doesn't sound that way. Well, now we're going to take why adding more rating factors actually will make it a little bit easier to understand by looking at a direct comparison of risk rating 1.0 to 2.0. So we're going to take where I've broken this down. There's more changes than what I've listed here, but these are the big ones that you're going to want to be considering when you talk to your clients. So the first is the preferred risk policy. So in risk rating 1.0, and I say currently, but actually the last day to buy a preferred risk policy was August 31st of this year. So preferred risk policies are no longer a thing in the NFIP. But under risk rating 1.0, structures that were not in those high risk flood zones. So imagine, when you look at a map, it's the areas that are not the shaded areas. They could buy a policy called the preferred risk policy. That was it combined building and contents coverage at a very, very low premium because FEMA considered those buildings at a lower risk. You're not in a high risk zone, the shaded areas, you're in those low risk zones. So, for example, about $250,000 of building coverage and $100,000 of contents coverage, which is the max available in the NFIP for a single family dwelling. That cost around $600 under risk rating 1.0. Well, risk rating 2.0, they have gotten rid of the preferred risk policy. Now, it's not all bad news, although, as I've shared with Shannon, a lot of the comparison work that I've done actually shows that out of about 6 PRPs that I tried to compare to risk rating 2.0, I think only 2 were less expensive than the expiring policy. So basically, risk rating 2.0 says that PRPs are no longer available. Those that have them will be grandfathered in. So your PRP won't go away if you have one, your clients have one already. But rates for the PRPs may be going up and down. So it's not all going up. Some will go up and some will go down. Like I said, out of the 6 or so that I've looked at, only 2 are going down. The other 4 are going up, some a little, some a lot. So it's all over the place, and we really don't have a good sense at this point if there's kind of a pattern on which ones are going up and which ones are going down. And I think there's probably going to be questions, and I will definitely get to those at the end. So grace periods. Now, whether you realize it or not, there are grace periods under the NFIP, which have really been beneficial, especially during the pandemic. In fact, for a short time during the pandemic, FEMA extended their grace periods. But under risk rating 1.0, there was a 30-day grace period after the expiration of a policy where you could still pay the policy and get coverage back in place. So there was no lapse in the policy at all. So that's the 30 days after the policy expires. And then there was another 60 days after that, so a total of 90 days, where you could pay the policy. You would have a gap in coverage, but you would retain grandfathering. So if there was any type of beneficial rating associated with a policy, you would retain it if you paid within 90 days. So the NFIP was being very, very generous for a long time. They were giving people a long time to get that payment in and retain grandfathering. Under 2.0, everything is contained within 30 days. There is no longer a 90-day grace period. And the reason that I highlight this as a major change is because we used to be able to tell people, well, yes, you might lose your coverage, and yes, you might be able to go back to the NFIP and still retain your grandfathering if you do it within a certain amount of time. Now it's all within 30 days of the policy expiring. So if you don't pay that policy within 30 days of the expiration date, then you will lose any type of grandfathering or beneficial rating that the policy had. So let's go back to the PRP for a second. I mentioned that those would be grandfathered. So if you have one today, you would have one under risk rating 2.0. Unless you don't pay it after 30 days, it expires, then you would lose the PRP. So you can see how this becomes extremely critical under risk rating 2.0. At the end of the day, just pay those policies on time. That's the best way that I can put it.
So Joe, on the PRP, they're going away, but you can assume them, but you can still get a new policy. So can you explain that difference a little bit? It seems like, so the PRP price might go up and it might go down even if it's grandfathered, but you can still get a new policy because you're talking about the properties that were traditionally most likely in X zones, right?
Yeah. Policies that were in the X zone. You can still buy a NFIP insurance policy for those structures. That's a very good point. It's not what we're saying here is that PRP set limits, the 250 and 100, used to be at a set price, and it used to be, I think it was around $600 when they stopped selling them a couple weeks ago. I think that was around what the price was, about $650. So now when you go buy those similar limits, 250,000 and 100,000 of coverage, there is no set price. That may be higher than the $650 that the PRP cost, or it might be lower.
So when you say the old ones are grandfathered, are they grandfathered at $600 for those set limits, or that
they are, and then
based on the third bullet point may go up or down?
Yeah. So what happens is if you have a PRP that would be going down under 2.0, then it goes down immediately. So you actually see that benefit upon risk rating 2.0, that renewal of that policy. But if you have a PRP that shows, and FEMA's displaying how high your policy will go. So if FEMA says, okay, your $650 premium should actually be, and I have a couple of these, going to $2,000 a year, then you will just simply retain that premium at like $600 or $650, in each year see an increase as you head towards the $2,000 that FEMA says that you should be at. So the PRP doesn't just go away all of a sudden, but it will start to increase towards those higher premiums if FEMA says that you're headed towards those higher premiums.
I guess their risk is, though, here for them is that those that have the higher premiums, because they're not required to take out flood insurance, are going to cancel their policies and only leave the lower cost policies in place.
That is, you are not missing anything. You're absolutely right. That is a very big concern that we have. That's not so much fact more than it is our kind of thoughts and opinions, which is we're concerned that the elimination of the set pricing under the PRP program will cause a significant number. And let me give you kind of a crazy statistic. 50% of the NFIP's book of business is preferred risk policies, if you can believe that. So the NFIP 50, I think it's actually like 48% of all the 5 million policies that the NFIP has, 48% are preferred risk policies. And, I don't have the entire book of business to show what's going up and what's going down, even though FEMA's put some information out there like that, but they don't break it down by policy type. My guess would be that this is where a lion's share of the policies that will leave the NFIP will come from.
And Joe, while you can grandfather, are they assumable?
Yes.
Under the new thing? Okay.
Yeah. So that's one of the great things. And that's a really good point. I bring it up in the part of the program where I talk about things that won't change. Things that won't change is you'll be able to actually take over somebody's policy and retain the beneficial rating, just like you are able to today.
Okay, great. Thank you.
Yeah, not a problem. Ryan's the only one that gets to interrupt me during my presentation. No, those are really great questions, and I'm glad you brought them up. So we're going to look now at elevation certificates. Currently today, elevation certificates are required for most new construction. And they have the ability to give you good or beneficial rating if you get them for existing structures. They don't always give you the beneficial rating, and in that case, you just don't use them, but they are able to. In the elevation certificate, the information on there that we use today are things like the base flood elevation, height of the lowest floor, the community information, and map information. Well, under risk rating 2.0, FEMA will determine the first floor height by using internal data. Now, I give a couple great examples here in a few minutes about why an elevation certificate, in my opinion, is even more important now than it was before. And we're going to explain that when we look at the examples. So an elevation certificate can still be used, right? Because FEMA is determining that first floor height by, artificial intelligence and data that they've gathered and estimated ground elevations. So the best way, though, to get your actual floor information, ground elevation, is by an elevation certificate. So it will still be required for what Shannon will talk about, which is floodplain management. So don't think the elevation certificate is going to disappear. It's just not going to be required for that. If you're in a rush to get a policy and you need one the next day and you don't have an elevation certificate, and it's not going to be required. CRS, I think Shannon may talk about this, but I'm going to just briefly talk about CRS, where today the discount is really only available for those buildings in the high-risk flood zone. And for all intents and purposes, it will be available for buildings all throughout the community. There are some conditions that do apply, but I guess the biggest takeaway here is that the CRS discount may be expanding on where it's available within the community. Mitigation. I think this is where Shannon and I both have some concerns on the new rating. Currently, there is no significant benefit to elevating mechanical equipment. If you elevate that furnace out of the basement, it has no impact on an insurance premium. Flood vents that are put into a foundation, in some cases, can actually make a significant impact on crawl spaces and full story elevations under certain circumstances. Now, under 2.0, while there is a discount for elevating mechanical, it must be moved to the entire next floor. And I give a picture at the bottom straight out of the flood insurance manual where it shows a slab, and that's a slab on grade. So bringing your utilities, they would have to go into the attic in that case in order to receive the discount. And the discount isn't big. It's about a 5% discount onto your premium. So it's not a huge discount, but it is there. And then one of our biggest concerns is the venting discount for flood vents, where you could put them into a crawl space and receive, in some cases, a big discount, has been significantly diminished. So I'm seeing discounts that were giving people several $1,000 decreases going down to about $150. So this is one area that we have some concerns. You'll actually see that in a few minutes. And just the rate tables, as a real estate professional, as land surveyors and others used to be able to open up the flood insurance manual along with insurance specialists and actually see where the rate table is that their rate's coming from. And even if you didn't understand the numbers, at least you could say, here is the number that your building's being rated off of. That is gone. Any rating examples that I have or that you want, you have to go through an agent. You have to get them through the FEMA rating system. There is no longer published rate tables. So how is this all going to work? Well, starting, it really was August 26th, but it's okay. FEMA had said August 1st. NFIP would release the rates. They did that closer to September 1st. But on September 1st, FEMA did release final guidance and documents for Risk Rating 2.0. So the final flood insurance manual is available, and all of that information is out there. Now on October 1st, and really starting already for policies with a 30-day wait, that is when Risk Rating 2.0 will be available only for new business. You will not be able to get Risk Rating 1.0 policies after October 1st. And really, you can only get them right now if you have a loan closing happening between now and the end of September.
Okay, so Joe, that was my question. When you say only available October 1st and beyond, that's what people are wondering. So if they're putting something under contract today and it's going to close after October 1st, and the buyer goes to a insurance agent, they're going to be quoting them on 2.0 at this point, right?
Correct.
Okay, so October 1st is not the quote, it's actually the closing of issuing the policy. So those insurance agents have already made that adjustment.
Yes, the companies, if you go into a company, insurance company, to get a quote and you click a date that's October 1st or beyond, the system is automatically generating new business policies under Risk Rating 2.0. So while it's a little misleading because it says, hey, we are starting October 1st, it's really already started.
So the one thing to look out for that I see on the horizon for our members is if they have a closing that's scheduled in late September and it gets pushed till after October 1st, then they need to immediately talk to the insurance agent when they know that date's getting pushed back.
That will definitely have an impact on your insurance for sure. Existing policies that are renewing between October 1st and March 31st. So if there's policies already out there, they will have the option, if the renewal comes in lower, to move over to Risk Rating 2.0, or if the renewal is higher, then they stay with 1.0. Now, this is also a little misleading because FEMA will only be issuing risk rating 1.0 renewals. So individuals will have to go to their agent and say, what does my risk rating 2.0 look like? And then the agent will rate compare. Conversely, if they don't do that, then on the following renewal, and they should have been moved to 2.0 now, and they weren't, they'll get a refund. It's a little confusing. I'm not sure why FEMA did it this way. Well, I think I do know, but we'll just say that they're working to correct what I feel is kind of a confusing situation by issuing those refunds if you're not moved into risk rating 2.0 and you should have been between October 1st and March 31st. And then April 1st of next year, all of this back and forth and new and old and all of that, that goes away. Everything's renewing into 2.0. Everything is being quoted new as 2.0. Obviously, that's October 1st. And we just go into 2.0 and it's like 1.0 was never there. Policies will not be immediately going up to their full risk rate, even though they'll be quoted their full risk rate. If they have a premium that's going higher than their current premium, they'll be grandfathered in and see increases slowly up to that point. So I have an example of that coming up here. All right, so what is not changing? This is very helpful, I think, because yes, there's a lot of confusing changes going on, but there's a lot of things that will remain the same. The existing legislative issues, such as an affordability framework, forgiveness of the debt, and annual rate increases, that is Congress. That has nothing to do with the changes happening under risk rating 2.0. The available amount of insurance, 250 for a single family or 1 to 4 family dwelling, that will not change. So we're not changing the amounts of insurance that are available. Mandatory purchase, this is where it gets really confusing. The requirement to carry insurance is not changing. So yes, under 2.0, we're throwing out those flood maps. They really don't matter. We're focused more on where the building is and its location to water and all those great things. But the lenders are still going to be asking whether the building is in or out of those high-risk flood zones. So yeah, that's adding a whole nother layer of confusion here. So if you're confused, you're not alone. We're decoupling the insurance from the maps, but the lenders still need the maps to know whether you're in or out. So that becomes still something that we're going to be looking at and dealing with. Policy forms have not changed. So the policy forms, the coverage you had before, the coverages that you have today. The CRS program and credits, again, that is changing a little bit, but the actual structure for the moment has not changed. The write your own commissions are not changing. The LOMA program, so remember, we're still, are you in or are you out? And so that letter of map amendment or the ability to remove yourself from the requirement of carrying flood insurance, that is still a thing, so that continues. ICC amounts, we're going to forget about that. Those aren't changing, but it's not important for this presentation. In assignment of a flood policy, as I noted before, not only does it remain the same, it becomes more important now because you're preserving that lower premium that you had before if you have an existing policy and you need to assign that to a new owner.
Joe, question is about the fact that are you in or out for mandatory purchase. Well, does it matter now whether you're in A or B zone at that point, or does all that differences kind of go away and it's just basically mandatory purchase or non-mandatory purchase?
That's it. The lending regulators changed their rules, I believe, in my opinion, in anticipation of this happening, and basically said, look, they used to really care about the coverage that you got depending on the zone that you were in. Now they really only care whether you're required or not required. So yes, the zone determinations will tell you what zone you're in, but as long as it's VA or X, that's in or out. So it really no longer matters the exact zone that the building is in for mandatory purchase. It used to matter a lot more. Now it no longer matters. And because of that, we're going to start to see the removal of the not yet, but soon we're going to start to see the removal of the requirement to have the zone listed on the policy. That has been a huge problem for the private flood and NFIP working. Some do it, some don't. That's going to start to also go away. So again, we talk about where things can be easier now. That is definitely a place that becomes a little easier because you're either in or out. Doesn't matter the zone. Great. So here are the impacts. I think some of you have seen these charts nationally. 23% of policies will go down. 66% will either not go up or go up about $10 a month. And then the other percentages go up a little bit more and then significantly. And in Massachusetts, our numbers look a little better, probably because we have a lot more pre-firm, and pre-firms in general have more going down than up. So a lot are seeing immediate decreases. You'll see the numbers there, 49% either no or small increases, and then the rest are seeing those significant increases. So let's see some real world examples to show you. Okay, so here's an example where the building's premium is going up. This is one of those this is an unfortunate example. So you've got a new building. This is new construction. This is a real world example. All location information has obviously been removed. New construction, it's a crawl space in an AE zone. So it's got those flood vents in it. It's about 1,000 square foot home. I mean, this is a very typical home you would see on Cape Cod or the surrounding area. $305,000 is its replacement cost. And it's got $250,000 in building coverage on the policy with a $10,000 deductible. Well, under risk rating 1.0, it's paying $881 for flood insurance. And under risk rating 2.0, if we did not apply the elevation certificate, it's going to $2,700 or almost $2,800. So that's a pretty steep increase. Now, it will not go to $2,800 on day one. They'll go up on what they call the glide path at 18% a year until they get to that $2,800. But once we apply the elevation certificate, it goes down to $2,467. So you'll see that so that the FEMA, and you'll see at the bottom, I have the FEMA determined first floor difference. Now, the way that FEMA is doing this, and try to imagine this, FEMA's not saying the first floor is at elevation 4.5. What they are calculating is the difference between your lowest grade and first floor. So they're saying that difference is 4.5 feet. Okay. But when we apply the elevation certificate, FEMA was off by almost a foot, because the real difference is actually 5.3 feet. That's why you're seeing the decrease in premium. That's why I recommend, wait till you see the next example. That's why I recommend getting an elevation certificate for many of our buildings, because what you're going to see is this is probably going to happen more often than we would like to think, where FEMA's off by a significant number. So with the elevation certificate, of course, the premium is lower. But what I really want to point to you here is, if we said that there were no flood vents in the building at all, the premium only goes up by about $100 and some odd to $2,544. So if you look at with EC at $2,467 and then no vents at $2,544, that difference is the discount that the flood vents were giving the building. So I think where we're seeing concern is the flood vent credit that used to give the discount to go down to $881 is no longer a significant discount. So this is where we're a little concerned. And this is what we're seeing across the country. Now we take let's go on the extreme opposite of an increase. We're looking at this building. It's an older building, but it's elevated on piles. So imagine a building built in the 70s up on piles because it's near the water. It's about 3,700 square feet. It's got about a $615,000 replacement cost. This is probably a typical building you would see near the ocean on the Cape. It's got $250,000 in building coverage and $10,000 deductible. Well, under risk rating 1.0, it's paying $9,100 a year in flood insurance. That's a significant bill, that's probably about what a lot of buildings in these high risk zones are going to be paying. But under risk rating 2.0, it's going all the way down to $1,728. That's a great discount. I would imagine that they're going to want to jump on that right away upon the policy renewing. If we apply the EC, it goes down to 1411. So they do see an even further discount if you apply the elevation certificate. And in this instance, there's no vents or enclosure or anything. There's no need to see what the discount is with vents because there's no place to put them. But look at the FEMA determined first floor in the elevation or the actual first floor. As an 8.5-foot difference. FEMA was wrong by that much. So I guess the point is get your elevation certificates. They are still just as critically important. And that is my presentation on risk rating 2.0. So I know there's probably questions. I'll let Ryan decide whether we answer them now or we wait.
Yeah, I'm going to hold a couple till after because I think Shannon may address some of them in the stuff, Joe, as well. But you are, I think you are available to consult homeowners as well, right? I mean, that's kind of what you're doing at this point, right?
Well, I am certainly able to answer questions. I am actually so busy, I'm not taking on any clients at this moment to help consult individual homeowners. But I am available to answer your questions, general questions, certainly more than happy to do that.